Quick question, does having multiple savings accounts really hurt your credit? And even more important, is that the right question to even be asking? So in this video, I'm actually gonna address that because that is a question that apparently you guys are asking and nobody's offering the answer to. So, does it hurt your credit score to have multiple accounts like checking accounts or savings accounts? The answer is absolutely not. In fact, it helps. In fact, banks love it if you have multiple accounts, especially if, well, not just multiple accounts, but you got money in it too. We like to have money in those accounts, right? So it actually helps. So good news is you're safe. If you have multiple checking and savings accounts, not an issue. Banks don't even think to even ask that question. What does hurt your credit is not multiple checking or savings accounts, but it is about multiple credit card accounts and what kind of loans you have. So let's talk about that instead. Let's talk about really what does hurt your credit. Now, if you're always applying for new credit cards all the time, especially if you've got more than 3 credit cards or any kind of revolving line of credit, this even means if you go to a furniture store and you get financing, that's considered a line of credit. When I was younger, I remember I opened up a credit card at a store, a department store, because they said,
hey, you open up a credit card here, it'll save you 15, 20% on your bill. I said,
I like saving money. Sign me up, right? And everybody's offering you a credit card at different stores. That all works against you. Those actually hurt your credit. It's okay to have some credit cards, but once you go beyond about 2 or 3, your credit score starts to get worse. So, does it hurt your credit? Absolutely, that can hurt your credit. Multiple savings accounts, checking accounts, not at all. Now, here's a big word of warning. Some people hear this and they say,
oh my goodness, I've got those store accounts. Oh man, I should have got that Banana Republic card again.
Okay, calm down. We don't want you to cancel these cards because if you cancel them, guess what? That'll hurt your credit. Now, if you set it up last month, you cancel it, it's not gonna do much. But if it's something you've had for several years, the one thing that banks do love, or that credit companies, when they're looking at your credit score, they do love, is they do want you to have long credit history, especially if you've been paying on time. So don't go canceling these credit cards. If you already got like 8 credit cards, don't go canceling them. It's okay. You can have them. Just let them season, let them keep going. And let me give you a few tips to help you even improve that credit score based on wherever you are. Okay, so number 1, here's this magic formula, right? I mentioned 3 credit cards is the magic formula, but if you have more than 3 credit cards, it's okay. Don't cancel them. It's fine. Don't cut them up like Dave Ramsey says, or put them in a block of ice, unless you need some real help. You're like a drug addict, but you're addicted to credit cards. That's another story. But 3 credit cards, okay. Also, what's good to help you build your credit is getting a car loan, like an installment loan. So a car loan is a great way to help build your credit. After that, having at least 1 mortgage will help build your credit. So the magic formula is this: 1 mortgage, 1 car loan or student loan, and 3 credit cards. That's your magic formula. If you have at least those, your credit is going to start building nicely. Now, to help further build your credit, here are some other things you should do. Number 1, if you have a credit card balance on whatever cards they are. See, credit scores, when they look at it, they're looking to see what's going on. Like, they want to know, how much of your credit are you using? Is it going up every month? Is it going down? They want to see if you need the money. Remember, no one wants to give you credit when you need the money. They only want to give you credit when you don't need the money, right? It's just like Harry Potter and the Sorcerer's Stone. When Harry is looking for the stone, he actually gets it, he finds it in his little pocket, he's like, whoa. By the way, spoiler alert, if you haven't watched the movie, I'm ruining it for you. But Voldemort, the villain, he's the bad guy, he needs to have it. He's gotta have it. Just like that person that needs credit, I've gotta have it. Well, obviously, it doesn't take magic to say we should not give it to that guy. Banks are the same way. They're like, I should not give it to you because you need the money. The only time banks want to give you money is when you don't need it. So you need to look financially healthy to them to say, oh, you look good. So one of those are the credit card balances. What's your balance to limit ratio? If you're over about 45% or about halfway or more of those limits, guess what? That actually is hurting your credit score. But if you start paying down those credit card balances, and it doesn't matter which one, I would actually recommend looking at another video we talk about, the cash flow index, where you figure out which credit card is best to pay off first. Hint, it's the one that has the lowest balance with the highest payment. That's the ratio you're looking for. But as you're paying down those credit card balances, it doesn't really matter. The total balance to limit ratio, if it gets below half, your credit score starts to improve. When you get below about 20%, especially when you get below 11, 10%, then at that point you've optimized your credit score. Just so you know, even if you're below 10% right now, but it's not all the way paid off, it doesn't really hurt your score all that much. It almost doesn't have an effect at all. So that's the good news, is that we want to get your credit balances below. But if you're over 50%, get it below 50%. Get it to about 45%. If you have $10,000 of credit card limits, get it down to $4,500. If you get $100,000 of credit card limits, get it below $4,500. All right, this next tip is going to be really good. In fact, it's so good that, as you can tell, if you get in here, we have the garden guys keep coming closer and closer to the window to see if they can eavesdrop in on us right now. So it's okay. So tune in, you can lean in too, and hopefully we can let the gardeners go their way. But this second thing is important. If you don't have to keep paying all your cars down to below 45%, there's another option. Increase your credit limits higher. Because you can either let them go lower or you make them go higher. So say that, for example, you have $10,000 of credit limits and your balance, say, is at $5,000. But if you can get them to raise it up to $20,000, guess what? You're still at $5,000. Now you're at 25%. Funny enough, even though they offered you more credit, your score jumps up because now the balance looks a lot lower. This is why you have to be careful about where those limits are. You got to know where they are and see how they're reporting to the credit companies, to the credit bureaus, because you might never know what's actually really hurting your score. So do that. Also, look for derogatory things. What are some negative things in your credit report? If you've ever had lates, how recently was it? If you're trying to get a loan, you want that to be at least 12 months old. Once it gets beyond 24 months, it goes beyond 2 years, it gets a little bit better. Once it goes past 7 years, it almost drops off. It's kind of negligible, right? But watch out for those negative things in your credit report. This also means watch out for medical collections. If you've ever had, medical bill, it might have been $20, or well, okay, maybe not been $20. Maybe it's like $60. If it shows up as a collection, that's hurting your credit. Get them paid off, get rid of them, so then you can move forward and start building your credit more. Okay, so that's big. Here's a bonus tip. I shared this in a different video. One thing you can do to build your credit score too is become an authorized user on another credit card that's got a lot of credit history, good credit history preferably, and their balance is below 10% of the credit limit. So for example, I needed to boost up my credit score to get a mortgage at a very lower interest rate, but I didn't have the credit score to do it. I didn't have really the credit history. It wasn't that my score was bad, but the history wasn't very long. So my score wasn't great, not yet. But I went to my dad and I said, Dad, you remember that Visa card we used to buy books in college?
He's like, yeah?
Put me on as an authorized user.
Why? What do you need it for?
Nothing. I don't even want to use your credit card. Send it to your house, cut it up. I don't need it. I just want to show up as a user on your card so that I get all your credit history back to 1995. He's like, yeah, but how's that going to hurt me? It won't. But I get to borrow that credit history. That one credit card will now show up on my account, on my credit history, as if I've had it the entire time since I was basically 18 years old. He said, all right, I'll do it. And he did. Didn't affect his credit score at all, but it boosted mine 23 points. So that's a huge bonus for you. Now, here's another magic formula too. If you're trying to get qualified for a loan, banks like you to look sexy, right? And sexy to a bank means you don't look like you need the money. So 3 things help. One we just addressed big time was the credit score, right? We want to make sure that credit score is up there, at least 680, but even over into the 700s. If you get over 740, 760, you're at a good start to be able to walk on water. Well, not literally, okay? Don't try walking on water and then try to sue me for that. I'm not saying go walk on water. I mean, that's figuratively speaking here. I just mean the banks will love you, okay? So get that credit score up. That's number 1. Number 2 is have at least, if you're trying to get a mortgage especially, have at least 12 months of mortgage payments. So if the mortgage payment you're trying to get is, say, going to cost you $2,000 a month, you're going to want to have $24,000 sitting in your savings account untouched for at least a couple months. They want to see at least 2 bank statements where it's been sitting there, you didn't touch it, just like Hammer says, can't touch this. Don't touch it, okay? So don't touch that money. You let it sit there, and they love you for it. They think that's good. Okay, so the third thing is this, debt to income ratio. They want to know what your monthly payments are on your debts compared to your income. That's a big thing to look at. This is why that cash flow index is important. You want to make sure it looks good. You want to make sure it never goes over about 45% of your income. So if your income is $5,000 a month, we don't want to see those monthly payments, including your mortgage, going over about $2,250 a month, right? So figure out what that is there. I've seen people with perfect 800 plus credit scores get denied because they either didn't have the savings or they didn't have a good enough debt to income ratio. So those things are very important. Those are the three things. So again, to recap everything I talked about, right? You can build your credit doing those different strategies we said. You don't need multiple savings accounts. It actually helps if you do, especially if there's a balance there that has at least 12 months of your mortgage balances, right? Your mortgage payments in there. And then of course, you have a good debt to income ratio along with this great credit score. Hey, tell me, like, what were some of the biggest ahas you got from this video? What are the best credit tips you got from this? And you want to be able to watch more, check out what are the different types of savings accounts that you can use where you can earn a better return than just leaving it in the bank.